with America in particular, they're a different market altogether, and they operate differently, which is an interesting and a really good conduit into what's happening over in Europe. Because when we look at what's happening in Europe with the European Central Bank, they're actually expected to cut rates.
Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics such as investing, cash flow, budgeting, saving, passive income, debt management, and much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, here we are. We are back again for another podcast, and it feels weird because I feel like I should be turning that way to look at you.
Andrew. For those listeners and viewers of ours, we've actually swapped seats, right? And this is not for any other reason other than the highly technical fact that my laptop is not charged and the cord is not long enough to reach the PowerPoint, so we needed to swap positions. But yeah, there you go.
Yeah, that's all right. We're still here. We're still here. Feels weird, but we're still here.
That's it. The high quality that everybody is used to will still continue. We've found a way around it.
So. Exactly right.
Andrew, what are we talking to everybody about today?
So today we are back again with another market wrap. So we're going to do the rounds and see what's been happening in investment markets over the last month or so.
Fantastic. So we might kick it off, Andrew, with America. Standard & Poor was a pretty good month for the month of May.
Yeah, absolutely.
Up Standard & Poor 500 up 3.34%. It's pretty good.
Very, very significant.
Pretty good. I mean, look, if you extrapolate that out over 12 months, geez, you'd be pretty happy with that rate of return, right?
Yeah, I think we say that every time, but it doesn't work like that. I think the previous one was down a couple of percent. So I think it's just a bit of recovery from that and a bit more buoyancy in the market. But really being pulled by the Magnificent Seven. I think now they're the Fabulous Five. There's always a new name, but I think the US market is really being pulled by some really big players over there.
Not wanting to sort of derail us for a sec, but the person or the people that come up with these names, because the finance industry and the money markets and the stock markets, they come up with these great names.
Yeah, look, the names are great, but how do you get it to stick is the question. I mean, who's the first person that says it and then gets it to stick?
This is what I'm saying. So Magnificent Seven, and that just became part of the lingo, and
everyone adopted it, and that just came in, and now it's Fabulous Five. Apple, Amazon, Microsoft, Google, and the story of the year or 2 years, Nvidia.
Absolutely. Yeah. I mean, that one, look, we're recording this just a couple of days after month end, and they're hitting record highs in terms of their share price. They're going to be the most valuable company in the world.
Sure. I think they just overtook Apple for spot number 2 now.
Yep.
And it's just incredible. Unbelievable to see the rise and the impact that AI is having in, particularly Nvidia, but the tech sector of the market. And really those 5 companies have been pulling the US market upwards. So I saw a statistic. I don't know exactly how much truth there is to it, but about 25% of the growth of the overall market in the US in the last 12 months has been purely funded by Nvidia.
That's insane. I mean, look, if you expand that thinking a little bit to the Fab Five and you think about Amazon, Apple, Microsoft, Google, Nvidia's a bit of a case of its own because it's a different company, it's newer. But if you think about how long those companies have been around and how big those companies are, you don't normally see the level of growth associated with big companies. Like, it's hard to grow a big company, and these guys are managing to do it and hitting record highs and driving, like you mentioned, 25%, driving the entire market and lifting it up. It's a fantastic story. Whether it's sustainable, what does that look like? But at the moment, I think a lot of this is the AI thematic starting to play out. Definitely in Nvidia's case, because they do provide the chips for the computers that are running the AI. But this has been an absolutely fantastic result. And we're starting to see some things in Australia as well too. Like I was reading this morning that CBA have hit record highs. NAB, I think, are up 38% in terms of sort of year-on-year growth as well too. Westpac as well. Like, seeing large companies moving so much, it's pretty phenomenal.
Yeah, and I think a lot of that has to do with some of the excitement that's sitting around AI and some of the technology applications that'll improve efficiency, mean that businesses can run with leaner manpower and essentially have more work that can be done in an efficient manner, and by using and leveraging AI. So I think there's two sides to the equation, right? And it's how excited is the market getting, and is this overestimating, the impact that AI will have in business, or is it underestimating the impact that it has in business, and we haven't even seen the start of it yet?
I kind of think back to the, and I paused there, Andrew, for a sec, because you're older than I am, so I'm just going off. I'm just going off rumors and innuendo here. But no, I remember back to the .com era, and basically all of these internet companies were coming out of thin air. And if you think about what that looked like at that point in time, those companies that were really big back then, the majority of them don't exist today. So yes, the technology was there, but are the companies that are emerging today in the AI space, because definitely that theme is here to stay, but are the companies that are emerging at the moment in the AI space the ones that are going to be the ones that are around in the future and the market leaders? We'll wait and see. I'm not sure, but it's it's pretty exciting.
Yeah.
Andrew, tell us, inflation data in the US.
Yeah, so we did see inflation data. It was marginally lower than expected, which essentially is keeping the hopes alive for a pre-election rate cut. So we may be seeing some rates in the US potentially come down. And what we did see was that the PCE, which is what the Fed's preferred measure of inflation is, was in line with expectations. So headline was up 0.26%, and core was up 0.25% month on month. So it's one of those things that is showing some light at the end of the tunnel in the US in terms of their inflation. The trend is obviously still high, but there's a bit of light at the end of the tunnel, particularly in the US market.
If we annualize those out, let's just have a look at those. We spoke about the S&P 500 if we annualize that out before, but let's do the same thing with inflation. If we do that both on headline and core numbers, because they are month-on-month figures, we're looking at an annualized inflation rate of either 3.5% for headline inflation or 3.25% for core, which is in a great position, but it's just a little bit above. So a little bit more work needs to be done with that. So I guess as a result of that, what we're seeing is the Fed remains on hold.
Yeah.
So they're in a position that they want to wait and see in this instance, and let it wash through and do its thing. But look, I think it's looking really good, and hopefully that continues and we do get into the target range. And once again, talking about rates on hold, cutting, what does it look like? If I'm putting myself in the chair here, this is a really big promotion, but if you were making that decision, you wouldn't want to be changing the rates unless you desperately needed to. Because if you think about the low interest rates that we had previously, it's so hard to get them back up again, because, and not that you want high rates, right? But it gives you the ability that if you are at a normalized rate position, it does give you that tool in your arsenal where you can either increase rates if you need to or decrease rates if you need to. Whereas if you think of the record low interest rates that we've had previously, 0.1%, you've got no room to move. You can't go down. How do you cut rates any further than that? So yeah, from my perspective, I think it's going to need to be a compelling reason before rates start to drop.
Yeah, absolutely. And the other thing that's also been impacted by driving inflation down is obviously GDP growth. So what you're now seeing in America as well is that GDP has come down, or the expectation for GDP has come down from 1.6% to 1.3%. But really that's mainly driven by lower consumption growth, and net exports is also coming down. And so you're seeing the US economy slowing down as a result of inflation also coming down and all of the added pressure there, which is what you want to see. But I think the positive thing in America, which is a little bit of concern around Australia, is they've managed to bring inflation down and GDP still remain relatively stable, which we'll touch on Australia a little bit later on. But the concern within Australia now with some of the most recent data is that inflation is still relatively sticky, and it's proving to be stickier than what it is around the world. But at the same time, GDP growth is really starting to stagnate, and what you're starting to have concerns about again is all of a sudden stagflation again.
Yep. We'll get to the Australia story. We'll get to the Australia story because with America in particular, they're a different market altogether, and they operate differently, which is an interesting and a really good conduit into what's happening over in Europe. Because when we look at what's happening in Europe with the European Central Bank, they're actually expected to cut rates in their rate review this week.
Yeah.
And what the market's pricing in, they're actually pricing in a couple of rate cuts, 2 to 3 rate cuts by the year end. So from their perspective, it's completely different to what's happening and what we're seeing in America.
Yeah, one of the first times that Europe is leading the world. But they seem to be the first central bank that are likely to drop interest rates. But Europe has been through a much slower period. And their inflation data, as well as the GDP growth, has come down significantly more than what the rest of the world has, which is why they're almost needing to drop rates in order to spur on economic growth once again.
Yeah, yep. Andrew, let's pivot across to Australia.
Yeah, Australia. So I think one of the things that made people relatively concerned was that CPI in April rose 0.73%. So we're now at 3.6% year on year versus the 3.4% that was expected. So those mortgage holders out there that were expecting rate cuts and wanting rate cuts to come in sooner rather than later, it looks like that is really being pushed out. I mean, the expectation is at the earliest probably end of this year and realistically probably start of the next.
I've been having some conversations with people around, how does this transpire? And I've been thinking about a really succinct way of trying to explain it. And I think I've come up with a way. But if you consider people that have got mortgages, they've got kids, maybe they're a little bit younger, whatever it may be, interest rate increases are going to impact the mortgage repayments. And rough rule of thumb, about 30% of your household income goes towards your mortgage repayment, right? So you're really affected by the movement in interest rates. So that will then influence the amount of discretionary income that you've got to be able to then spend in the economy. So what you do is you tighten up because things, you've got less money and it starts to slow things down, which then has an impact on inflation. On the flip side, if you take somebody who doesn't have debt, let's assume that we've got a retiree or a pre-retiree and they don't have debt, interest rates are higher, which impact term deposit rates of return. So people are getting potentially more money on the deposits that they're holding with the bank. They don't have the level of cash flow impact on their mortgages because they don't have mortgages. They're getting more money in terms of income, so they're still spending. Yeah. So from that perspective, you've got the interest rate lever that the Reserve Bank is using to try and slow the economy. But for one part of the population, and I don't have the statistics or numbers on me in terms of how much that represents in bits and pieces, but for one part of the population, it's actually doing the opposite and it's fueling
even more inflation.
So the thing that I'm thinking of is maybe we need to start thinking about this a different way from a policy perspective, because that blunt instrument of just increasing interest rates is great for a portion of the population in terms of what it's designed to do. But for the other part of the population, it's actually doing the opposite.
On the exact opposite of what you want to do. And so what you then need to start to think about is, okay, well, you probably need fiscal policy to drive down inflation there rather than just, the instrument of monetary policy and rising rates, because it's only going to impact a portion of the ultimate population.
100%. Andrew, let's pivot into maybe the property market, construction costs. Yeah. Everybody loves to talk about property. It's our national sport here in Australia. So
we love talking about property. Look, I think what we've seen in terms of construction costs rising has only been accelerated even further. So construction costs have even accelerated more in the past few months. And so really the concern with that is you've got an environment whereby there's already a supply of housing shortage. Yep. So what you're seeing is rental prices increasing extremely dramatically. More people coming into the country by way of migration, and most of these migrants aren't even allowed to purchase property because on those visas they need to be a permanent resident in order to be able to purchase property. So you've got more people or even greater demand for rental properties, then you add fuel onto the fire and say, okay, construction costs have now also increased, which means that the rate of development is slowing down and the pressure on builders and developers is slowing down. And so where you'd, find your large, big block house and have one dwelling and one family living there, developer comes in, puts 3 townhouses on there, and all of a sudden there's 3 families living on that one property. That's not happening nearly at the rate as what was happening previously. And so all of a sudden you're really adding kerosene to the fire. And the expectation, at least from our end, around what's likely to happen with rental prices is only to push on further. There doesn't seem to be too much light at the end of the tunnel. And eventually that's going to have an impact on property prices as well. Because if rental prices are getting more expensive, then the yield for investors is higher, and all of a sudden investors are willing to spend more on properties, and you start to see how that picture plays out. So one simple thing around construction costs and the environment that we're in can have a pretty significant impact on a whole bunch of different things, and the property market in general.
It's easy to overlook the impact that the property market has on the broader economy, because it plays such a huge role in terms of everything from housing to construction to rental to migration to a whole range of things at the moment. And it just seems like a bit of a powder keg in terms of what's happening. And I don't know how the government's going to navigate that out, because what we need to be producing in order to meet that supply versus what we're currently producing, there's a pretty big gap in between. So that's going to be interesting to see how that plays out. But I think essentially what this looks like is that we could probably, in Australia, expect inflation to be a little bit stickier than what it is. And, that really depends on how effective the measures that the government are putting in place. I mean, obviously the federal budget came out. The politicians are talking up, things like the electricity rebate that we're all going to get. They're talking about the stage 3 tax cuts that they didn't endorse originally, that they're taking credit for. So that's going to be interesting to see how that plays out. But where it goes, what we can expect, I think at least from an interest rate perspective, we're going to see rates on hold for longer than what we anticipated, I believe. And there's been, some talk in the media, at least of late, that we're not going to be seeing anything happening until next year. And it's not necessarily just, if rates aren't, the thing to be clear about is rates, if they're not increasing, it doesn't necessarily mean that they're decreasing. Yeah. And I think, like my comments before, from a Reserve Bank perspective, they much prefer stable interest rates. And if they can keep it on hold, they will. And I just think that we're going to continue to see it on hold for a period of time until we see how this plays out.
Yeah. And look, this is having an impact, and what we're experiencing maybe on a day-to-day level rather than looking at, macroeconomical picture. So take this with a grain of salt. But property investors are really starting to consider whether properties or whether a particular property is the right asset for them. And so what we're starting to see is, your standard property investor has a mortgage on the property, so their costs of borrowing have gotten significantly higher. The land tax rates have gotten significantly more expensive, and so you're starting to see pressure on land tax bills. The fact that you're needing to do gas, electricity checks, the costs of maintaining and holding an investment property at the moment are very, very significant. And so what you need in return is either capital growth or income, and investors are pushing for income in order to supplement some of those costs. Mm-hmm. And there's not a great supply of properties, and so they're getting that level of income. But property investors are still feeling the pinch, and they're really finding it difficult to justify the expense of holding and maintaining an investment property. And so a lot of the work that we're doing at the moment is considering whether that's still the right asset class, whether that still forms part of the long-term plan, and making sure that you're not making a emotional decision based off circumstances just right now, and looking at the longer-term picture. But it's starting to impact the investment property market as well.
And if you think about it, because interest rates are higher, if you need the income to be able to support the debt associated with the investment, and the yield on a particular property is, high twos potentially, and you look at that and go, okay, all of these regulations that you're talking about, there's the land tax issue. I'm not going to realise the capital gain for potentially decades down the track versus, and I keep going back to this term deposit thing, versus I'm going to put the money in a term deposit. I'm going to get high fours.
I'm not going to need to worry about
not going to need to worry about absolutely anything. I don't have to worry about if I've received capital growth down the track to realise the gain. It works, I understand it. It gives me a decent enough rate of return that can supplement my income now. Maybe I do that instead. So we are seeing people that are just having enough, especially in Victoria with the land tax changes as well too. It's just another tax essentially on people that own property. So yeah, we are definitely seeing that. How it plays out, time will tell. Whether or not that continues to fuel inflation, we'll see, because for every seller of a property there has to be a buyer, right?
Yeah, exactly right. But I think the general consensus in Australia is inflation's going to be stickier, which means rates are probably going to be higher for longer. And there's some concern with that as well, in that the GDP growth within Australia is a lot lower than what was originally expected as well. And so you're starting to see inflation without actual GDP growth. So we'll need to wait and see how that plays out.
And look, Andrew, not that this is the episode for the shameless plug, but I think with the level of complexity and what's happening in the economic environment, I think now more than ever, and we keep saying it week in, week out, but getting advice around putting a strategy together in terms of making sure that you're optimizing your financial position, you've got clarity on what it looks like in the future for you. I think there's no better time than doing it if you've been thinking about it and sitting on the sidelines. There's definitely enough going on in the world that you want some help to be able to navigate this effectively.
Absolutely, Bills. Absolutely. Thank you to all of our listeners and our viewers. It was great to jump on the podcast again, and we look forward to catching you on the next one.
Cheers.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amaridis and Andrew Nicolou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of AMP Financial Planning.